Hello, fellow Rebel Capitals. Hope you're well. So this evening, we've got three huge topics to discuss. Number one, the curve has uninverted. So this begs the question, is the stuff about to hit the fan? Number two, Elon Musk is wrong, not just wrong, completely wrong about consumer price inflation. I'll explain why in just a moment. And then finally, we've got my good buddy Brent Johnson coming on to talk about the dollar. And are we seeing the dollar milkshake play out right in front of our eyes? So you're definitely gonna want to stay tuned for that. Again, we got Brent Johnson coming on live here in just a moment. So first topic of discussion, like I said, let's get over to what is happening with interest rates and what's happening with the Treasury curve. Looking at interest rates, going over to CNBC here, let's actually refresh and get this going in real time. There we go. And we've got Fed funds at the range 4.25 to 4.5. We know that. So it's going to be right around where the actual IOR is going to be right around where we're seeing the 1 month Treasury trade. So I'm guessing 4.33. We can use that as a proxy for where IOR is at any given time. So we look at the front end of the curve, we see that we still have an inversion between Fed funds, or most likely still have an inversion with IOR, or we'll use that as our proxy for Fed funds, even though it's a range, right? And assuming that we're right around 4.33, we've got the 1 year at 4.27. But when you go out to the 2 year, we're looking at an uninversion. But more importantly, guys, let's go down to the 10-year Treasury yield, and we can see this at 4.57. So just as a reminder, the 10-year Treasury yield has traded under Fed funds for, the last 2 years? A long time. That is highly abnormal. If you just think about it, would you expect interest rates to be longer, or would you expect interest rates to be higher the longer you lend someone money, or the shorter time that you lend someone? Obviously, the longer you lend someone money, the more risk you have. Number one, they're not going to pay you back. Number two, that you're taking inflation risk. So of course, if you lend someone money for 10 years, you would assume the interest rate, or what you would have to be paid to compensate you for your risk, would be higher than if you're lending someone money overnight. So when you think about it in those terms, it shows you how abnormal this is for the yield curve, not just the 2s and 10s, but especially the overnight rate, IOR set by the Fed, and the 10-year Treasury yield. But now we have seen it uninvert. And you guys know by watching my videos that the stuff doesn't really hit the fan usually while the curve is inverted. It usually hits the fan when the curve uninverts. And we talked about the 2s and 10s uninverting, and now we've got to the point where the 10-year Treasury yield has uninverted with the overnight rate. So let's go ahead and look at kind of some history here so we can get our head around the probability of whether or not we should expect to see the stuff hit the fan in 2025, or if this time it's different. And there are no certainties at the end of the day. There are only probabilities. So here is the 2s and 10s. Let's not focus on that. Let's just go straight to Fed funds and the 10-year. Now, when you look at, let's actually go back to late 80s here. So late 80s, you can see as far as timing, this is a lot better, as you would expect, than the 2s and 10s. So in 90, January 90, we had the Fed funds and 10-year uninvert. And then we had the official recession start in July. So about 6 months later. Now we fast forward to, let's say, .com, curve overnight and 10-year uninverts right around March 01. And we were basically, that was basically the start of the recession. Same thing with GFC. We basically uninvert, I mean, just a slight uninversion there, but that was brief. The sustained uninversion we get December 07. And again, that was right at the start of the recession. And a little different here with cerveza sickness, where we uninvert October 2019, and then the stuff hits the fan, obviously, in February, March. So the outlier is, I would say, you could say is 95, right? But I really hesitate to use 95 because it was just like the 3-month or the overnight rate in the 10-year. I don't think the 2s and 10s inverted. Very weird looking yield curve, by the way, back then. But we didn't really have the whole curve inverted. I don't think the SOM rule would have been triggered either. So I don't know if that's a good apples to apples comparison. So let's focus on .com. And look at this. We had a huge inversion in 98. And then we had a massive uninversion. Now, you would have expected, at least I would have expected, this stuff to really hit the fan in December of 99, right here when we get this big uninversion. And this would have been a result of the Fed dropping rates, probably going in. You know what, though? That's a little weird because you younger people might not remember this, but the reason Alan Greenspan did that was because of Y2K. A lot of young people watching this video right now probably don't even know what the hell I'm talking about. But for you older folks out there, you know exactly what I'm talking about. I mean, that was a big concern. Remember that? Y2K? And I remember Greenspan did these preemptive cuts in front of that just to kind of soften the blow, which turned out to be a total nothing burger. But I think that's why we probably saw this massive spike. And I don't know if we would have seen the curve play out like this if it wasn't for Y2K, because what this tells me is probably not a lot going on at the long end of the curve, more so at the front end of the curve with the Fed playing around with rates. But we can cross-reference that by looking at the 10-year and going back. And yeah, it was going up. It was going up. So it was going up from 98 and the Fed dropping. And that's why you had that huge spike, or that huge steepener, I think would be a better way to say it, that we're seeing right here in the chart. So you know what's weird is back then, I'll bet you what the long end of the curve was telling the Fed is that you are dropping rates and you probably shouldn't be. And therefore, inflation growth expectations increase until we get to this huge uninversion after Y2K. And then the long end is probably saying, hey, guys, now you need to drop by even more, where a year or two ago, you shouldn't be dropping that much, right? Maybe that's what the curve was trying to tell them. Who knows? Obviously, there's a lot of noise in these charts, and nothing goes up or down in a straight line. We don't have any linear action here, although as human beings, we tend to think that way. So this is kind of the outlier here. So you've got to ask yourself the question, do you think it's going to play out more like .com? And this would be just kind of like that balance sheet recession. Or do you think it's going to play out more like GFC, where we have an all-out liquidity event, to put it mildly? Or do you think this time is going to be completely different? And if so, why? And now if you say because the unemployment rate is low, well, that's a bad argument, because the unemployment rate was low here and here. If you say because we have growth and inflation expectations increasing, that's a bad argument because we had the exact same thing happen here and here. If you say, well, interest rates are going up at the long end, well, the exact same thing happened here and here. So I'm not saying there's not a good argument, but the main arguments that you hear on FinTwit, I don't think are that powerful, right? So what we need to, and I wish these charts were in real time. I mean, Fed, you've got 900 PhD there. Can you not give us some real-time data? But anyway, this is a couple days old, but this would be uninverted. So then we have to ask the question, what are the probabilities that we get the stuff hitting the fan going into 2025? Or, are we in a GFC type of moment when this uninversion with overnight rate and 10-year actually represents the start of a recession when we get to, let's say, December of 2025, and we're looking back in the rearview mirror. Remember, that's exactly what happened. I hear a lot of these. I was listening to Gunlock this morning, and he comes out, he says, well, obviously we're not in a recession now. Obviously we're not in a recession now. I don't know. I mean, that's exactly what they were saying in December of 2007. Obviously we're not in a recession now. The CPI is going from 3.5 up to 4.5. Obviously we're not in a recession now. We've got the unemployment rate super low. Just because the NBER, I'm not saying that we are in one, don't get me wrong. But what I am saying is just because the NBER hasn't come out and made the official announcement, and just because we've got positive real GDP, and just because the unemployment rate is low, it doesn't necessarily mean that we're not in a recession. Because pretty much every single time we've entered a recession over the last, let's say, 40 years, the setup, if you will, was pretty much the exact same. Right? I mean, let's look at the unemployment rate as an example. I should have had that pulled up, but let's just go there. Hopefully we can pull up Fed funds. What? Not now. Okay. Fed funds, here we go. Or the Fred charts, just to keep things consistent. So look at the start of every single recession. The unemployment rate is always extremely low. Always. So this is nothing new. But what's crazy is people act, and like the experts even on CNBC act as if the unemployment rate being low in and of itself is an indication that the probability that we're in or headed to a recession is very low. I mean, it's just look at history, for heaven's sakes. Now you look at GDP, same exact thing. Now you look at when, you got to go back and do some research. It takes some effort, but you look at what the headline number was in 2007, maybe December, Q1 of 2008. It was a positive number, right? And then a year later, when the NBER comes out in December of 2008 and says, oh yeah, by the way, that red hot economy we were telling you about, actually we've been in a recession for the last year. And oh, by the way, that positive real GDP that we are using as an example of the economy being very strong, yeah, actually that was negative. They come out with these revisions. It's almost like the narrative is, for lack of a better term, like the Titanic. And it takes a lot to turn that giant ship around once the momentum is going this way. So you have all of the economic data becoming weaker and weaker and weaker and weaker, all this anecdotal evidence. But the bureaucrats are hesitant to go out on a limb and say anything that's off consensus because their main priority is keeping their job. So my point here is you never get the NBER, excuse me, actually saying that we're in a recession until it is so completely obvious that everybody already knows and has known for, let's say, 3 or 4 months. And then they'll say, once it's totally consensus, and once even Jim Cramer is coming out and saying that we're obviously in a recession, if not something worse, then it's like they get the green light to go ahead and say that we've been in a recession, because at that point in time, there's no risk in their jobs in doing so. I think that plays a big, big part in what happens typically in these cycles. And again, I want to be very clear. I am not predicting that 2025 is going to play out exactly like 2008. I am not saying that. So, people say, oh, George, you are so bearish. Oh, George, the stock market's at all-time highs, loosen up, blah, blah. Look, I'm only saying that the arguments that I'm hearing for why it's impossible we go into a recession in 2025, I don't think hold up under scrutiny when you look at past recessions, because it's the exact same arguments that we've heard. And it's the exact same process as far as interest rates, the 10-year having a lot of noise, or sticky inflation. That's low unemployment, positive GDP growth. It's what we see every single time. So I'm not saying there isn't a good argument, but the main arguments that I hear, I think, are extremely, extremely weak. So main takeaway here, guys, from topic number 1 is total, not total, but the main points on the curve that we typically focus on to not only determine the health of the underlying economy, also to determine what the bond market is telling us about future growth and inflation expectations, but also, maybe more importantly, when we're getting close, potentially, to a recession, that last domino or that last shoe has dropped. And that last shoe was overnight rate, 10-year treasury yield, an inversion. We just saw it happen. Next topic, guys. Let's go over how Elon Musk is completely and totally wrong about inflation. Now, I want to give credit where credit is due. Elon Musk, obviously a smart dude, and he understands some very, very complex topics extremely well. Unfortunately, the monetary system is not one of these topics that he understands, one of these complex topics he understands. Let me show you what I'm talking about. And hopefully, there's no way he's going to watch this, but hopefully he does. We can always just keep our fingers crossed, right? So let's start by looking at this tweet. I tried to pull it up. It's taking me a little too much time here. And we're actually going to watch a video of Elon Musk reiterating this point. He says in this tweet, and he's retweeting, let's see, Natalie Danielson, who's retweeting Thomas Massey. And, Thomas Massey is another guy that I think is great, but it's blatantly obvious he doesn't really understand the monetary system, and he just kind of regurgitates talking points that he has heard from gold bugs or Bitcoiners. Not to say that there aren't some gold bugs or Bitcoiners that really understand the monetary system. I'm not saying that. I'm just saying that the vast majority of them don't, which isn't really a knock, because I don't know that there's any group of people where the majority actually do understand the monetary system, because it's very counterintuitive, obviously very complex, and it just requires years and years and years of research and thought. So just because I'm saying they don't understand the it's not like a knock against them. I'm not saying, oh, these guys are stupid or anything like that. Okay. So Elon says exactly right. All government spending is taxation. The government either taxes you directly or increases the money supply and then taxes you through inflation. That means the spending bill is the taxation bill. Very important concept to understand, which, again, I don't want to knock on Elon because he's doing so many great things, but I think that's ironic that he says very important concept to understand when it's very clear that he doesn't understand the concept. Sorry, Elon, just calling a spade and just trying to use this as a learning tool. Not for Elon, because there's no way he's going to watch this, but just for the overall audience, because it's important we understand this stuff. I mean, how can you determine the probabilities of the stock market doing XYZ or the economy doing ABC when you don't have a grasp of how the money system actually works? Right? You've got to have at least a broad stroke understanding of how money works. I mean, is there anything more important to actually, set up your portfolio and do all these other things that we try to do by watching videos like this? Okay, so getting back to it here. Now I'm going to, Josh, let's switch up the screen share, and because I want to actually play a video on Twitter. So I know it's a little cumbersome, but let's do a Chrome tab and let's do Twitter, and there we go. Okay, Josh, can you see this Twitter feed?
Yeah.
Okay, so what we're looking at, guys, is Elon Musk's Twitter feed, and I want to start by playing this video where he's kind of reiterating what he said on that tweet. And then I want to kind of go through his feed where I'm pointing out some other things. And by the way, some great things that he's talking about. And then I'm going to explain why I don't really think he understands what he thinks he understands.
We have to reduce federal spending. There's no way to make up for it other than reducing the federal spending. And as I mentioned earlier, like a very important point that I think is important for people to understand is that all federal spending is taxation, because what they don't receive, what the federal government doesn't receive in direct revenue.
In other words, what the government doesn't receive in taxes, then that creates a deficit, and they have to borrow, right? They have to borrow.
They make up for in inflation. They just print money.
So what he's implying here is the deficit in and of itself creates additional M2 money supply, currency units chasing goods and services, which puts upward pressure on consumer prices or leads to an environment where consumer prices are higher than they otherwise would have been. And I want to emphasize that last point because it's a point Austrians make, which I think is very, very valid. It's not just, so as an example, if prices are going up by 1%, even if you say, well, that's not a big price increase, I think the Austrians would come in and correctly point out that, yeah, but without the increase in money supply, we could have seen maybe, you can't prove it counterfactual, but we could have seen inflation at 0 or -2 or something like that. We could have seen positive deflation, but instead we saw prices flat or prices up 1%. So anyway, let's get back to the Elon clip here. And so the first thing I'd like to point out, just to reiterate, is he's saying, and I'm going to take him literally, and then I'm going to try to give him the benefit of the doubt here too in just a moment. But if we're taking him literally, he is saying that we've got taxation, then we've got deficit. That's government issuing bonds, then pulling in money from the private sector. And then this process, and then when they spend that money back into the economy, is somehow increasing the amount of currency units that are chasing goods and services. Josh, let me go ahead and write, just remind me on this. The number one point I want to make to give him credit where credit is due is I'm going to say Fed's BS. Just writing this down in my notes. And then number 2, we're going to discuss Aggregate balance sheet. Aggregate BS. Okay, anyway, let's get back to the Elon video.
So all federal spending is taxation. Very important principle. Almost nobody, very few people seem to, even like, somebody's like spend their life in economics. I'll mention to them, hey, all federal spending is taxation. They're like, first they'll argue with me and they're like, then they will agree. It is. Because it is either direct tax revenue or it is inflation. All federal spending is taxation. So we must reduce federal spending or we will go bankrupt as a country.
So he's bouncing around a lot there. But, Elon, I'm not an economist, but if you want to have this conversation, I'm happy to have the conversation with you. I'm happy to do a whiteboard video for you and explain exactly where you're making some mental errors there. But I'm going to try to explain it here on this video. So now that I've done that, let me go ahead and let's go through his feed here and point out maybe some other mistakes that he's making, but then other things that I would absolutely applaud him for. So let's just, I know he had some things here. This is hilarious. We're the media now. You guys can see what that says. I think that's great. Here we go. This I want to applaud him for, because out of all the things he's been talking about, I think, the deficit and how are we going to pay our debt, and that's, is that important? Yeah. But is that a big deal right now? No, absolutely not. I mean, look what interest rates are. I mean, I say this all the time. We don't have a problem with demand for our treasuries. That is not an issue, right? And it 99% will not be an issue over the next, 5-10 years, unless the monetary system completely and totally changes to where the euro dollar system doesn't require those treasuries to function. Okay. So anyway, getting back to this, the point he is making here, I think, is incredibly valid. And this is what we should be focusing on, guys. He says it's getting to the point where doing anything at all is illegal in terms of business. Bravo. Golf clap. This is what we got to be focusing on. It isn't necessary. Now, if we can reduce government spending, great. Awesome. But our focus should be on reducing regulations. Our focus should be reducing red tape, bureaucracy. Our focus should be unshackling the private sector to allow them to do what they do best. And that's kick ass, take names, produce goods and services, and increase the standard of living and increase economic growth, right? Which in and of itself would decrease the amount of government spending relative to GDP and the bigger share of economic output that is produced by the private sector, let's just say because of this reduction of regulations and whatnot. Therefore, by definition, the economy is going to become more and more efficient. The more efficient the economy is, the more that benefits everyone, but more specifically or disproportionately benefits the poor and middle class, right? It's all about reducing regulation. And if we can reduce government spending at the exact same time, fantastic, fantastic. But we've got to remember where our priorities need to be. Because let's just assume for a moment, we said, okay, well, we want to get hyper-focused on reducing the deficit because debt to GDP is at 120%. And therefore, we're going to take our focus off of reducing some of these red tape issues or bureaucracy. Let's just assume they did that. Okay, now we're being counterproductive. You guys get it. Let's keep going. Here we go. Bravo again to Elon Musk. Deleting nonsense regulations to fail to serve the greater public good will lead to new age of prosperity. The only thing I don't like about this is fail to serve greater public good. Who determines what the greater public good is? Well, let's just focus on deregulating and focus on free market capitalism. I mean, that's where we got to start, right? And free market capitalism, well, I didn't say capitalism. I always say free market capitalism because what I'm implying with that is that you don't bail people out. I don't care how big the bank is. You don't bail them out. That's not a free market. That might be capitalism. That ain't the free market. That's crony capitalism. That's corporatism. I would argue economic fascism. So I think our North Star should be asking ourselves, number one, is this constitutional? Number two, is this representative of free market capitalism? No, get rid of the rule. Yes, okay, fine. That should be your North Star, in my view. It shouldn't be, or maybe, to be fair, is on net balance, is this regulation that we think we need going to be a net positive for our efforts to achieve maximum free market capitalism, right? So we want to achieve maximum to the degree to which we can. Doesn't mean eliminating all rules, but if you do have a rule or regulation, it should be on net balance over the long term. Is this going to benefit the private sector and the economy and society at large, or is it going to be a net drag? Right? I don't think it should be just serving the greater good, because again, that is who on earth is going to be able to determine and define what the greater public good is. I mean, that's how we got into this problem to begin with, right? Is that all of these, show me the regulation that wasn't sold to you as though it's going to benefit the greater good. Like the EPA, the Department of Education, any of these things that have hamstrung the economy, let's say, were sold to you and continue to be presented as if, on net balance, they serve the greater good. So I don't want to nitpick too much, but I'd like the emphasis to be a little different there. But overall, I love the message. Okay, now they're talking about this spending bill. And here's where Elon derails. America is headed for a disaster with no money for anything unless government overspending is addressed. That's again, what this implies to me, if I'm understanding it correctly, is there's no money. All these foreigners are going to stop buying our treasuries, and there's going to be no demand for the treasuries. So we're not going to have any money to spend unless we just increase taxes, and we can't do that because that's going to be counterproductive. And this idea that there isn't going to be demand for our treasuries if we continue to deficit spend, this is nonsense. This is nonsense. And it's not just George Gammon talking, for heaven's sakes, right? Just look at what the interest rates are telling you. If you can show me where the long end of the curve, which, by the way, just uninverted with Fed funds, it's been under Fed funds for 2 years. That is the opposite of demand evaporating. That's telling you that there is massive demand. And keep in mind, we have run huge deficits. The debt in the United States has gone from 22 trillion, roughly in 2019, to 36 trillion. And you still had the 10-year treasury trading under Fed funds. That is not an example of lack of demand for treasuries. It's an example of massive demand. And you say, well, George, how do you know that demand is going to be sustained? Well, it's actually, if you go and look at why interest rates have been below Fed funds, if you look at why the long end of the curve hasn't gone to 10%, let's say when the CPI is running at 9.1, once you understand the mechanics there, then it becomes clear as to why the probability of the long end blowing up due to lack of demand is incredibly low. And by the way, if demand ever did go down, that would require a total and complete change of the global monetary system. So ask yourself what the probability of that happening overnight. Incredibly low. Okay, so now let's get, and I know we've got Brent coming on here very quick, guys. So remember, you want to stay tuned for that. We've got Brent Johnson coming on live to discuss how the dollar milkshake theory is playing out right now in real time as we speak. And what we can look forward to in 2025 is the dollar milkshake theory going to continue to play out, or are we going to see a pullback in the US dollar, a pullback in the S&P 500 like we've seen, and maybe dollars continue to chase assets outside? We're going to have to get Brent's take on this. So again, that's something you don't want to miss. But what I want to do now is go over why I'm saying Elon Musk is wrong about this idea that the deficit represents money printing, therefore it represents inflation. Let's go over why I think he's wrong, and then I want to give him the benefit of the doubt. Because this stuff does get complex. I understand it's nuanced, and he could just be wildly oversimplifying it just to make this digestible by a broad audience. I would just argue that he's oversimplifying it to such a degree that it's completely losing accuracy, and that's counterproductive. Okay, so let's think about this. Government issues a treasury, let's say for $1,000. Okay, so it's $1,000 deficit. Where does that money come from? Just like taxation, that money comes from existing money. That money comes from M2 money supply, assuming that it's a non-bank, right? I don't want to make this too complex, so we'll assume that this is a non-bank and not a bank buying the treasury directly from Janet Yellen. So non-bank, so you, right? Let's say that you buy a treasury from Janet Yellen at auction for $1,000. Fantastic. Where's that money going to come from? It's going to come from your checking account, isn't it? In other words, it's coming from existing M2 money supply or your savings account. And then it's going to go into the TGA, right? So they've taken existing money out of the economy. And then what is Janet Yellen going to do with your $1,000 she borrowed from you? She is going to respend that at some point in time back into the economy. So on net balance, what happens to M2? Nothing. It's a wash. Because you're not spending brand new money and therefore adding to M2, in other words, the amount of currency units chasing goods and services. You're simply robbing Peter to pay Paul. You're simply taking $1,000 over here and putting that same $1,000 over there. That's all that's happening, right? Now, let me go ahead and that's a big difference. That's huge, right? That's one of the reasons why you can see the Fed's balance sheet. Let's see, I know we got about 5 minutes here before Brent comes on. I think this is going to add a lot of value here, guys. So, excuse me, I want to take just a moment and let's look at federal debt. There we go. I had this chart pulled up. Yep, right. Thanks, Josh. And I see Brent backstage. Brent, we'll be right with you, buddy. Okay, there we go, Josh. Now, can you see the this Fred chart?
Yep.
Okay, so guys, this is federal debt, and let's just go to 1980. We're under $1 trillion. Call it 900 billion with a B, and we've gone from, just keep the math simple, $1 trillion to 36 trillion, roughly. Okay, 35, 36 trillion. This is an increase of, call it $34 trillion. What does that mean? That means that there's an additional $34 trillion worth of treasuries. Now, if Elon Musk is correct, then we should have seen M2 money supply in the United States go up by at least 34 trillion. Because he's not even factoring in the currency units that are created by the banking system, lending them into existence. He's just talking about deficit spending, right? But let's go ahead and pull up a chart of M2. And we can see that right now we're at 21 trillion. How? How? If the deficit equals money printing, then how did we add or in other words, the debt equals money printing, therefore equals inflation by creating more goods and currency units, chasing goods and services. How on earth can we have 34 trillion in debt and only 21 trillion in M2 money supply? The math doesn't work, right? And again, I'm not even factoring in the major money printer, which, as you guys know from watching my videos, is not the Fed. It's not the government. It's the banking system. It's the banking system. And what the Fed is doing at most times is totally irrelevant. Totally irrelevant. And the reason why I always like to start right around here in 1980 or so, and then go to especially 2007, because we had this huge increase in money supply from, call it $1.5 trillion to 7.5. And you guys know from watching my videos, what happened to the Fed's balance sheet? How much money printing did we have? None. In fact, I would argue we had money extraction if you just look at the Fed's balance sheet, because the number of electronic reserves went from roughly 35 billion in 80 down to under 10, while the overall reserves went from 40 to 40, flatlined. The bottom line, the Fed had, there was no money printing going on. There was no additional currency units being created. Where there is a slight argument, and again, this is another area where I want to give Elon Musk the benefit of the doubt. He could be talking about the idea that if the government spends this money, if they do the deficits, all these treasuries, additional supply hits the market. And because additional supply is hitting the market, demand for treasuries from foreigners is going to go down. Demand for domestic demand for treasuries is going to go down. And therefore, it's inevitable that the Fed buys these treasuries because no one else is going to buy them, and they got to keep interest rates low. They got to do yield curve control. And therefore, if they are buying from a non-bank entity, we are going to see an increase in M2. But this is making a lot of assumptions. And I don't even know that that in of itself would lead to inflation being higher than it otherwise would be, because you got to tell me what's going on in the banking system, right? If they're doing that because we have risk off, then the banking system is creating fewer loans. And the banking system is going to have way more control over M2 than Jerome Powell. I can assure you of that, regardless of how much QE or yield curve control they're doing. And by the way, why would they have to do yield curve control? Because every single time they've done quantitative easing, which is increasing the amount of bank reserves, the interest rates at the long end of the curve have gone up, not down. And when I'm saying I shouldn't say every time, but what I am focusing on is QE 1, 2, and 3. Look at what happened to the 10-year Treasury yield during QE 1, 2, and 3. Did interest rates go down like the Fed wanted to at the long end of the curve? Did the interest rates go down at the long end of the curve, which is the Fed's objective? Because they're buying more demand. No, it did the opposite. Why? Because it's not about what the Fed's doing. It's not about what the Treasury is doing. It's about growth and inflation expectations, right? But getting back to this chart of the federal debt, by the way, what did interest rates do? Well, let's just look at that 10-year chart from, let's just zoom out, go back to 80. So here's, we're 84. This is good enough. What did interest rate, because at 80, they would have been higher, by the way. What did interest rates do on the 10-year from 84 to today? When, by the way, the deficits were so huge that we tacked on another 34 trillion in debt, which if this was more currency units chasing goods, we should have seen massive inflation, and we should have seen interest rates do what? Skyrocket. If what Elon is saying is true. What did we see? The exact opposite. We saw disinflation, and we saw interest rates at the 10-year going down, not up. Now, I want to give Elon the benefit of the doubt. So, first of all, if he's talking about the Fed monetizing the debt, I would say I'm not going to give him a pass there, but I would say, okay, that's a better argument, but he's assuming the Fed is going to be doing something that they don't necessarily have to do. And I would argue would be counterproductive if your goal is keeping the long end of the curve down. Number two, and I think this is, if he is making this argument, or if he would make this argument, then I would definitely give him a pass. Because what we have to understand is, although deficit spending doesn't increase M2 directly, the amount of currency units chasing goods and services, it does increase the aggregate balance sheet. Let's go back to our example where you are buying a treasury from Janet Yellen for $1,000. She's deducting your account by $1,000. She's putting that $1,000 in her account, and then she's spending that $1,000. So someone else out in the economy has your $1,000. So again, M2 hasn't changed. But what did you get for that $1,000 you gave Janet Yellen and she gave to someone else? You got a treasury, right? So your balance sheet just went from having $1,000 to $1,000 worth of treasuries. It didn't decrease. But someone else's balance sheet went from $0 to $1,000. You see? So M2, the amount of currency units chasing goods and services, did not change, but the aggregate balance sheet actually increased. This is a good argument. But unfortunately, I don't think it's the argument Elon Musk is making. I don't think he understands it to that level of sophistication. But again, I just wanted to give him the benefit of the doubt there and not assume that he's saying something. I didn't want to put words in his mouth. Let's just put it that way. Okay, on that bombshell, let's go over to my good buddy Brent Johnson himself.
Hey, bud.
Dude, congrats, my friend.
On what?
The dollar milkshake theory.
I
mean, dude, we got stock. I mean, yeah, they've come down recently, but we're close to all-time highs. We got NASDAQ ripping. We got the dollar at like what, 108 now, over 108.
Yeah.
I mean, we've got interest rates going up, which I didn't think would happen. I mean, but that was your kind of base case. So my sister, in fact, she's a huge fan of yours. But my sister texted me the other day, and she was listening to one of these talking head podcasts like this one.
Yep.
And the guy was saying how Brent Johnson has got to be walking around Puerto Rico right now, like John Travolta and like Saturday Night Fever, you know, with like the collar out, just smoking a cigarette, just having a good old time.
I don't button the top button when things are going well.
Yeah. So let's just start here. Why has this happened in your view, Brent? And do you think this is going to continue into 2025? And by the way, if you want me to pull up some charts, I've got the DXY right here if you want to cut to that.
Well, I think the most interesting thing on the chart, on the DXY chart, is that the bottom in September, I think, came 3 or 4 days after them cutting interest rates.
Okay, so can you see this chart, Brent?
Yeah, I can see it. Yeah.
Okay, so I'll do
my eyes aren't very good, but I can see it.
Okay, so I'm highlighting right here the September, right around September.
I'm somewhat familiar with this chart.
Okay. Yeah, right.
So, if you look into September and you go back and you look and see where the Fed meeting was, I think it was around the 20th or something, right? And I think over the next 3 to 4 days, perhaps it kind of stayed at that level and maybe even went a little bit lower. And I remember at the time, the dollar was trading around 100, 101, something like that, or the dollar index.
Right around here. Yeah, I've got it pulled up here.
And, I was getting, of course, a lot of DMs and emails and stuff on Twitter, but, now they're going to cut, the dollar's going.
Yeah, they're calling you a loser. They're sending you memes of a milkshake spilling.
Right. And so, but it was less than a week after the Fed, cut, that the dollar kind of started to rise, and it kind of started to rise fairly aggressively. And here's the answer is going to be the same answer that I always give. And the funny thing, George, is people always say, Brent, you just keep saying the same thing. Well, it's because the same thing continues to be right. Why would I change when it continues to work? And the reason is because the people who were saying they're cutting, and so therefore the dollar is going to fall, are, in my opinion, making the same mistake that many people make, in that they analyze the United States in a vacuum. And it just, unfortunately, it's not the world is not a vacuum. There's a lot of other currencies out there, and they all trade relative to each other. So, the ECB is cutting, the Bank of Canada is cutting, Brazil's having all kinds of problems with their currency. China's, fighting a deflationary storm. And so they've been loosening monetary policy. Even Bank of Japan, a lot of people thought that the yen was going to rally back to 100 because they were going to now raise interest rates. But, it's hard for them to raise interest rates because they issued so many negative yielding JGBs. So, everybody's kind of stuck. And when everybody is easing, but the U.S. is easing as well. But if everybody's easing, and so when supply, is arguably increasing, then it comes down to a demand, right? Who's got the most demand? And the U.S. just quite simply has the most demand for their currency. There's more demand outside the United States for the dollar than there is inside the United States. And, you and I and Jeff and, people who've talked about this euro dollar market have kind of pounded the table on this. And I think people are actually starting to get it, right? But early on, they just couldn't get their head around it. But I think they're kind of starting to get their head around it now. And I think that's what we're seeing. We're seeing that, despite the Fed, taking their monetary policy lower or the restrictions on monetary policy lower and trying to free up more liquidity, the problem is that things are slowing around the world. There's more demand for dollars. And when there's more demand, even if liquidity is picking up, if demand is increasing faster than liquidity is, the price rises, right? And I think that's what you're seeing.
Let me push back here, play devil's advocate.
Okay.
You say demand for dollars outside the United States is increasing, but every headline I see shows that it's decreasing. We've got the BRICS. We've got China doing deals with India, doing deals with Russia. We've got China dumping, quote unquote, all of their treasuries because they don't want any exposure to the dollar. We see all these sanctions that were put on Russia, and therefore these global governments are seeing that risk, that real risk that might not have been there in 2020, 2021, and therefore they're, quote unquote, de-dollarizing. If we look at the FX reserves for a lot of these foreign central banks, we see them selling their dollars to buy gold effectively. So everything that I look at, I get the dollars at 108, but what I'm seeing is demand for dollars actually going down. So if the dollar is going up, then it's got to be because of a reduction of supply faster than demand is actually decreasing. But the main takeaway there, the main argument, is that demand for dollars is not going up, it's going down. And this will not only continue into the future, but will accelerate.
Well, I think there is a desire for demand to go down. I don't know if demand itself is actually going down. But to your point, there is a desire for the demand for the dollar to go down. So even if it's just staying flat, let's say it's not increasing as I suggested. Let's just say it's staying flat. But if growth is slowing and it's becoming harder and there's less circulation of currency because growth is slowing, the economies are not spinning as fast as they are, and money is not changing hands as quickly. This is the velocity of money, right?
Right.
And new credit is not being extended. All of that US dollar debt that exists in the euro dollar market, whether it's bank loans or whether it's vendor financing or whether it's, just invoices that are owed, that's demand for dollars. And if you owe a supplier $1 million, it doesn't matter if you don't like dollars. It doesn't matter if you want to decrease your demand for dollars. That demand exists, right? And the reason that supplier or that counterparty wants dollars is because they have dollar debts of their own, right? And so,
and a lot of their inputs for their economy are dollar denominated.
And a lot of their inputs trade in dollars. And so, this, in many ways, this whole de-dollarization in theory makes somewhat sense, but in reality, it's really a myth. I mean, I hate to be so black and white about it, but sometimes the only way to get the point across is to kind of really hammer it home. And, again, I fully admit there's great desire to de-dollarize, but in actuality, there's very little, if any, de-dollarization going on. And to your point, if it did go on, if real hardcore de-dollarization took place, it would send the dollar higher because there would be fewer dollars circulating, and all that debt still exists. All that, all the currently existing demand is still there. Now, future demand may fall if you start doing new deals in non-dollar. But the problem is there's so much debt out there and credit that's already extended in dollars. You can't move on to a new system until that debt is satisfied.
Let's reframe that slightly. And
Okay.
I just want to do this, Brent, because I understand your argument. I totally agree with it, as you know. But I want to reframe it so it's easier for the average viewer to understand exactly what you're talking as far as the mechanics. Because you said that because, let's just say there's 50 trillion in dollar-denominated debt, that the demand doesn't go down. I think a better way to say that is it is possible for demand to go down, but not below the amount of existing debt.
Fair. That's fair.
You see, so because I think that people say, Brent, you don't know what you're talking about, because if some Russian oligarch wants to de-dollarize, well, that means demand is going down. But what you're really saying is that there's a level that demand cannot go down below that based on the existing demand that's created to pay back those loans and to make those monthly payments. That's number one. Number two is I want people to understand that when you're talking about velocity, this is just a term that kind of wonky guys like you and I use just to talk about cash flows. So I think a better way to present this to the average listener is to say, look, you've got a $2,000 a month mortgage payment. Now, that mortgage payment is paid by you going out and working and getting a paycheck. Well, the reason you have that paycheck is because there is velocity of dollars going from your businesses or the guy that owns the business, from the customers to the business, and therefore the velocity can go from the business to the employee, and then the velocity of those dollars can go from the employee to the bank to make the mortgage payment. But what happens, what Brent's saying, is if velocity slows down because dollar demand goes down, which is what would happen, it's very counterintuitive, but this is what would likely happen, then you'd have this phenomenon where you have all this, Japan, as an example, has all this dollar-denominated debt, but they lose their paycheck. No more paycheck. No more paycheck. Your business just went bust. There's no more velocity. So in this environment, what would you have to do if you lost your job to make your monthly mortgage payment? You would have to sell something else on your balance sheet. You would have to sell your gold. You would have to sell your Bitcoin, or you would have to sell maybe another currency that you might own. And in Japan's case, or Japan Toyota, that would be Japanese yen. And if you're having to sell that Japanese yen, then you're increasing the supply of yen to buy dollars, which makes the dollar go even higher versus that fiat currency. So do you think I explained that well? And would you have anything to add to that to help it, to make it more digestible for the average viewer?
No, I think that's right. If you think, you just think of it from a cash flow perspective, that's probably the right way to say it. The only point I would add on to that is, let's say that the company you work for goes bankrupt, or their customers stop paying them, and then therefore your boss cannot pay you.
Yep.
And then you cannot pay your mortgage, and then too many people owe the bank. Too many people that have a mortgage at that bank stop paying, and then the bank gets in trouble, and the bank can't pay their credit. And so a slowdown in cash flow has a daisy chain effect on the whole system. Now, people go bankrupt all the time, and there's, missed payments all the time. And on a certain level, it's not a problem. But when it gets to a big enough level, it starts to become systemic. It's a literal run on the bank. That's what we saw in 2008, and that's what we saw in 2020. It was a global run on dollars. That's why money market funds even failed, because, they're sitting in the safest paper that there is, but even those failed or were in danger of failing because their counterparties stopped paying them, because there just was no flow of money, right? The velocity literally went to zero.
The circulation.
I mean, when you tell people to go home and stay there, what do you think is going to happen to velocity of money? right? And so, and it's just it's an effect of the design of the system. The system is designed in a way that circulation must happen. I've used the example of a shark before. You know, a shark has to keep swimming, you know, or because if it doesn't swim, it falls, it sinks to the bottom of the ocean. And that's the same way with the economy. If the economy is not moving, if it's not spinning, if it's not swimming, then it falls and it crashes. And you know, so velocity is extremely important. And you know, and I just caught a little bit of what you were talking about before I came on, and you know, you're talking about inflation and you know and stuff, and you know, velocity does affect inflation. You know, if there's high velocity, you're going to have higher levels of inflation. If you have very low velocity, you're not going to have inflation. You're going to have deflation and perhaps devastation, just because of the design of the system.
I want to back up a little bit, and I want to take it a step further. You talked about what happens if the business goes bust, then they can't pay the employee, then the employee can't pay the bank. And if you have multiple people that owe the bank, then that blows a hole in their balance sheet. That makes the velocity slow even further. But I also want to point out that increases risk and therefore decreases the bank's willingness and ability, for that matter, to lend
that's exactly right.
into the future. And let's think about that. If the bank on net balance is creating fewer loans than are being paid off, because again, no one wants these dollars, right? So they're going to pay off their debt. Then that means the supply of dollars is going down even further, which means the velocity, the cash flows, go down even further, which just exacerbates the problem for all the other existing businesses, and then makes it harder for the bank that's involved to stay in business, and decreases the probability or their incentive to create more currency units, because we have to remember that the vast majority of dollars, especially outside of the United States, are not printed by the Fed or the government or anything. They are lent into existence. Therefore, if you have more loans being paid off than are being created, supply of dollars goes down.
Right. That's exactly right. That's exactly right. You know, the other thing I didn't mention, and we don't have to get into this if you want, but you know, part of the reason demand for dollars is holding steady, or you know, if you want to say it's going up or whatever, is the tariffs, is the potential tariffs. You know, the dollar did pretty well post the Fed rate cut, you know, into the election, but it's doubled since the election, and that has a lot to do with Trump's policies.
You want to explain why that is? I mean, that's trade deficit and that's exporting dollars, but you want to explain that, Brent?
Yeah. So there's it's a couple things actually. So number one is, you know, the tariffs that he is talking about. It's a completely new way of doing business for the United States. You know, the United States did business like this 80, 90, 100 years ago, but they haven't done business like this in 30, 40, 50 years. I mean, of course, we do have some tariffs, but in general, you know, as a large policy, it has been tariff free. Right. And so Trump putting tariffs on other countries or on trading partners essentially means that they are going to get fewer dollars back in return for selling their goods in the United States. So again, all of that dollar debt is still out there. All of that credit, that dollar extended credit is still out there. But now there's going to be fewer dollars flowing back outside the United States into the euro dollar market. And so you have a situation where the supply of dollars in the euro dollar market is not as liquid as it has been. And it has the potential to go down even more, right? So if with the expectation of fewer dollars in circulation makes them on an individual basis more valuable, and it makes people want to hold on to them. And then that further exacerbates it, because again, then if you're holding on to those dollars because you want to make sure you have them when your when your liability comes due, that restricts the liquidity, it restricts the velocity. Right?
And let's not forget, Brent, that requires more yen to pay off that dollar debt, because the debt's going, or excuse me, the dollar's going up against the yen, and it requires more yen to buy that barrel of oil.
Well, and not only that, I mean, you're absolutely right. But what do countries do when they can't get dollars? They print more of their own currency to buy the dollars.
Right.
So then their currency increases in supply versus the US dollar, and their currency falls and the dollar rises on a relative basis.
Which makes that debt more of a burden.
Which makes it even more, it becomes a vicious cycle. And
No, it's like that Chinese finger trap thing.
That's exactly
Like
right.
the harder you pull,
That's
the worse
exactly
it
right.
gets.
Well, and that's why I always say de-dollarization, the more you try to de-dollarize, the harder it becomes to de-dollarize.
Yeah.
It's a trap. It's a prison. Like it's a monetary prison. You know, the rest of the world thought they were being very clever when they started using the euro dollar market because it's unregulated and they didn't have to, you know, adhere to certain, you know, regulatory standards and leverage standards. And, you know, it worked great for a while. But the problem is, you know, when the velocity stops and people stop, you know, when the music stops, there's nobody to ride into the rescue and put new chairs in there.
That's right.
And so, you know, we're not quite to that point yet, but the part of the reason that I have pounded the table as hard as I have on the whole dollar milkshake theory and the strong dollar, not because I absolutely have to be right, but mainly because I want to dispel all the ridiculous theories to the contrary, right? Or at least make people stop and think rather than when they read a headline on some blog or they hear some, you know, podcaster saying that we're going to de-dollarize and the bricks are going to rise and all the dollars are going to flow back to the US and nobody's going to want them anymore. Yeah. It just does not work that way. And the system cannot handle that. And it doesn't mean it can't happen. To be clear, it doesn't mean it can't happen. But if that were to happen, it would lead to the dollar going higher, not lower. And it would cause all kinds of volatility. Now, again, it doesn't mean just because volatility is bad, doesn't mean volatility can't happen. You can absolutely have it happen. It's just not going to be a calm process if and when that ever happens.
And I want to highlight one thing you just said right there. You said the system.
Yes.
So, and the reason I want to highlight that, guys, is because the dollar can hyperinflate. The dollar can crash. The dollar, it absolutely can do all these things. But to have that as your base case or your highest probable outcome, the system would have to change. As long as we have the system that we have right now, you've got the Chinese finger trap. The monetary system would have to fundamentally change to where, as an example, the Federal Reserve could impact, let's say, global dollar liquidity to a degree to which it would actually matter and move the needle. So if we have a central bank digital currency, that's the example I always use. If you had all the other entities around the world and all the other central banks, if they all had an account with the Fed and the Fed could just create bank reserves for this liquidity, then you're absolutely right. The dollar could hyperinflate because those dollars aren't being lent into existence. Those dollars are actually being printed. Right. So I just want to make
to have hyperinflation, you would have, first of all the other currencies would have to go into hyperinflation first. And then you would actually have to physically print the dollars rather than loaning them into existence.
Yeah.
Which
would require a mechanical change.
Which would require a change. The other thing I would say, you know, going back to the systemic issue, I'm glad you brought this up because whenever I start talking about this, somebody will say, well, Russia did it. Or so-and-so did it, or I got out of debt. I don't need dollars anymore. And here's sure, like one country perhaps can de-dollarize a little bit and maybe a certain company or certain individual can do it. But on a systemic wide level, it cannot happen.
One more thing I want to point out, we keep doing one more thing here, but but I think it's very, very important because people conflate China with all the businesses in China, or they conflate Russia with all the businesses in Russia, or they conflate Saudi Arabia or India with all of the businesses. And you've got to separate the two, right? So just because India is de-dollarizing doesn't mean that 99% of the businesses that actually make up the Indian economy are actually dollarizing, right? Yep. It's you've got to compartmentalize the two.
Right. Right.
Okay, what do you think about, let's start with interest rates going into 2025. We just had the Fed do let's say a hawkish, very hawkish a 25 basis point cut that just tanked the market. Market is up today, but starts up 300 points and then goes right back down to where almost flat from a technical standpoint. I know that ain't good, especially when you've had 10 or 11 days of straight down. So what do you think about interest? I mean, but then also too, the Fed funds in 10-year now uninverted for the first time in, call it 2 years. That's usually when the stuff hits the fan. And, now the market's predicting that the Fed's only going to cut a couple times in 2025. And the 10-year has gone up by, 30 basis points in the last couple of days. So what's your view there with rates going into 2025?
So the first thing I'll say, I'm happy to tell you what I think on rates, but I'm not really trading. I don't have a position on this, and I'm not trading. I can tell you why I'm not trading it, but actually, I do have a few TLT puts, but I started selling those today, and I'm probably going to be out of them very quickly. But in general, I think interest rates stay at this level or go higher. I'm talking 10-year or higher, right? I'm not talking about the Fed funds. I'm talking about the 10-year or higher, and for a couple reasons. Number one, okay, so I have to put a qualifier on this, right? I think they stay at this level or go higher unless they absolutely crash.
Which would be a recession, right? If we have a recession.
Which would be not just a recession, but some kind of a crisis where you have a massive run to treasuries just because you want the safest collateral, right?
So GFC, all bets are off, 10 years going to 1.5%. Okay.
Right. So, but if it doesn't do that, I think it stays at this level or goes higher. In other words, I don't think we have like a slow and steady rise or fall in the 10-year rate. And part of the reason is because I think inflation, again, unless we have a crisis where inflation crashes and actually becomes deflation, then I think inflation remains stickier than the Fed would like. I think the tariffs that Trump will put on, even if he just says they're coming and doesn't actually put them on right away, the expectations of the tariffs, I think, has the potential to, keep yields higher, or the expectations for inflation to be higher. If he actually does put them on, then I think it shows up in reality rather than just the expectation of it. And I think the government, despite Doge and despite Elon and Vivek's, very good intentions, I think it's been very difficult to actually cut the budget. And I think they can do some massive cuts, and yet we're still going to run huge budget deficits, right? And so I think people will still buy treasuries. Institutions around the world will still buy treasuries. They just might want to get paid more to do so. And the other thing I'll say is, and I think this may be a little bit hard to get people's heads around, and I don't know that I have a perfect way to explain this, but I'm going to try, is that the reason it's okay, or the reason rates are higher in the US is because they can be. And what I mean by that is the US is not in danger of not being able to fund itself. There is not going to be a situation where the US cannot fund itself, but Britain can fund itself, and Russia can fund itself, and China. So, there's this concept of the risk-free rate, and everything else is priced off of the risk-free rate. Now, I think that's a stupid title. There's always risk, right? But on a relative basis, the US Treasury is the safest credit. Doesn't mean that it's safe. It's just safest on a relative basis. And the reason is because they can print the money. They can print global money. There's only one institution in the world that can create global money out of thin air, and that's the US. So it doesn't really matter whether the rate is 4.5% or 5.5%, because they can just print it to pay it, right? And if any other, and here's the thing is, with US rates being higher, there's all over Twitter, all over the blogosphere, all over financial media, is this is going to cause real problems for the United States, and it does. It obviously will blow out the budget, right? But higher rates in the United States is a nightmare for the rest of the world, Because why on earth would you buy an Australian treasury or a Canadian treasury or a Turkish treasury or an Egyptian treasury if you can get 5 or 6% by buying a US treasury, which you have to operate on the global stage, and that that they're not going to go bankrupt because they can literally print it, right?
And is denominated in the same thing as the commodities that you need for the inputs.
And
for
it's
your
denominated
economy,
in the same
and
thing.
it's denominated in the same thing that your debt's
Exactly.
denominated in. And I mean, I could go on and on, but
Right.
yeah.
And so here's
the one thing I was going to say there too, Brent. I'm sorry for cutting you off, but and it is denominated in a currency that has been appreciating massively against your currency. In other words, your expenses. Even if the CPI in the United States is at 5, 6, 7%, you don't give a shit about inflation in the United States because you're not buying shit in the United States. You only care about the dollar versus yen and what it's doing relative to the inflation in your own currency, in your own domestic economy.
Right. And so I know there's probably people that say, well, yeah, Brent, they can do this, but it's going to kill the dollar. The purchasing, the dollar might be rising versus foreign currencies, but it's going to be falling versus real things. Well, that's very possible. That's actually what the milkshake theory says. Gold probably goes higher. Real estate and that isn't leveraged, potentially goes higher. Real things that can't be printed very possibly go higher. But there's always a but here. Because of the design of the system, fiat versus fiat does matter. People will tell me in a system where all fiat's getting debased, fiat versus fiat doesn't matter. But I was on here a couple of months ago when we wrote the paper on the carry trades. Every financial crisis that has happened in the last 50 or 60 years has some form of a carry trade involved in it, where somebody borrowed money, put it into something that they thought would be higher yielding than the money they borrowed in, and then it went against them, right? And so typically when you get into some kind of a regional, like the Asian currency crisis or the Mexican tequila crisis or even the global financial crisis, the reason it happens is because one fiat currency is rising versus the other fiat currency. And when that happens, and when it's the dollar rising versus other fiat currencies, then you have the potential for a crash, a collapse. And that's what we had in 2008, and that's what we had in 2020. And while there was definitely inflation coming out of those things, in the moment, there was deflation.
Of all assets, the correlation
of all assets. It doesn't matter. All assets, food prices, industrial metals, precious metals, housing, stocks, cars, you name it, asset prices all fall in a liquidating market.
Yeah.
And liquidating markets are caused by fiat versus fiat.
Yeah.
So even though we're in this environment where all fiat's getting debased and you should absolutely own real assets, you can't just say, I own real assets and I will be 100% fine, because that real asset could have a 50% drawdown. And if you need some kind of cash flow to pay your bills or run your business or service your debt, that asset may not be able to do it in the moment. And so unfortunately, there's no silver bullet answer to this, right?
Yeah, but what would you need, Brent? In that
you would need dollars.
There you go. I was just going to give you that softball real quick.
But see, this is the thing. A lot of people will say, well, you know what? I'll just use gold. But you would use gold to sell it to get the dollars to satisfy the debt.
Right.
You wouldn't actually use gold. Gold itself would not solve your problem. Gold would be the bridge to get you the thing that solves your problem.
Right. But you're selling the gold, which decreases the price. Right. That's why gold goes down. It actually goes down because it's doing its job, because it does have a bid in a crisis.
Yeah.
Tell us what's going on with the newsletter, my friend.
Well, thanks for asking. Yeah, it's been fun. We started about 6 months ago, and we've had a lot of fun with it, because really what we do, it's a little different than a typical newsletter. It's really more of a research service, because we're not necessarily just giving weekly updates on this is what the market did and this is what we're seeing. What we do is we find an issue that we think is interesting and that we want to learn more about, and then we go research it and we write about it, and we try to figure out how it can help our portfolios and help our clients. And then hopefully, if we think it's interesting, hopefully other people think it's interesting. As an example, we just put one out today where we're talking about Warren Buffett. And, one of the things when tariffs happen, one of the problems with tariffs is then it often will lead to capital controls and less liquidity flowing around. And so in that type of an environment, you may not feel as safe about investing in China or, Egypt or wherever it was as you used to, right? But you still might want to have some kind of exposure to that market. And so what you can do then is you find some kind of a proxy in a safer jurisdiction that has exposure to China. So let's use China as an example. You want to have some exposure to China, but you don't want to have your money in China. So you find a safer proxy that has exposure to China. Yeah, and so one of the examples we use is sometimes you find middlemen that, they operate in a different country, but then they have exposure. And so Japan has a lot of the middlemen. And so and Warren Buffett has huge exposures to these middlemen.
Yeah, right.
And so so we basically took a deep dive and we looked at what Buffett has been doing and why he's been doing it. And then we compare it to what's happened in the past and kind of what's going on now. It's just really interesting. So that's an example of a topic that we found interesting. We haven't necessarily implemented it in portfolios yet, but it got us thinking, right? And so if things continue the way we think that they might, then that might be a way that we end up getting some exposure to something that we otherwise wouldn't feel safe doing. And so we've done this for about 6 months and we've just given everything away. It is going behind a paywall on January 1st. So if you go to macroalchemist.com, right now, all the reports are free. You can download everything that we've put out. But
Josh, can you pull that up on the screen? Can you pull up that URL,
if you sign up now, you get a pretty nice discount and you're locked in for life at that price. And the reality is prices will probably go up next year. So if you like what we're doing, we'd love to have you as part of the community. What we're going to do, starting next year is when we put a report out, then we're also going to have a call sort of like this, and we're going to talk about the report and let people ask questions and almost like a book club regarding, the research that we put out. So
there we go.
Yeah, there's the reason.
Yeah. .com, Buffett, Japan, and Middleman. So serious deep dive that I'm sure provides a ton of value. All right, buddy. Well, I appreciate your time. Can't wait to see you here in a couple weeks, I guess.
Yeah, man. I'm excited.
Yeah, Brent's
I'm
coming
looking
down
forward
here to Medellin, and we're gonna have a good old time with Snyder, and Patrick Suresna is coming as well. I don't know.
Oh, that'll be fun. That'll be fun.
Yeah, Patrick's a great dude.
Yeah.
So,
and one of my clients is coming too, so it's gonna be fun to hang out with him, and he'll be there as well.
Yeah. All right, man. Enjoy the rest of your afternoon. Thanks again for your time, and can't wait to see you soon here in Medellin.
All right. See you, buddy.